So we're back again, Matt Piepenburg and myself. And I thought today we'd talk about, Matt, debt, really. Debt is really the reason, Matt, that we started MAM, because not the debt in itself, but the consequences of the debt is really why we started MAM, i.e. the risk was to us unacceptable already at the end of the 90s. And of course, now it's grown exponentially. By the way, if anybody asks, I have a red waistcoat on here today. That is thought to be a bit Christmassy, since we might not have another one of these before Christmas. So
good on you.
So debt was really the reason why we're here, and why what we thought. I decided at the end of the 90s that it was critical to protect against the consequences of this debt once imploding. And if we look back, there is $280 trillion dollars worth of debt today in the world. Of that, the last 275 trillion have been created since 1971. Yeah. And since 2000, 200 trillion have been created. So in the last 20 years, 200 out of 280 trillion global debt throughout history have been created. So we get into a crescendo now, and the risks are enormous, and it's absolutely critical in our view to protect against these risks, because the risk of implosion is massive. That's really why MAM exists, as we both know. And you have a lot of experience in debt also, because you obviously in your Wall Street days, you've traded debt, you've been involved. So it'd be interesting to hear your view on this matter.
Yeah, Egon, it's not just the staggering, disgraceful amount of debt, it's the quality of the debt or the type of debt, whether you're looking at corporate debt, public government debt, or even household debt. You have to look under the hood and even look at that. And if you look at just U.S. corporate debt, a sector that I'm quite familiar with over the last 20 years, it's important to step back and just look at the quality of that debt, not just the staggering amounts. We now have corporate debt well over 12 trillion in the US, but it's important to keep in mind that 67% or greater of that debt is comprised of what we call levered loans, high yield, or subprime, or just on the border, which is the D- students in the class, the bottom of the credit barrel. So just a little bit above 30% of corporate debt in the US is considered high grade or investment grade. The vast majority of that debt is very low quality debt. Again, the weakest students in the class. And they're teetering on the edge of a wave of defaults when this CARES package and fiscal and monetary support stalls. You also have to keep in mind that globally right now, 12% of all corporate debt is considered zombie debt. We call that walking dead enterprises. These are companies that have such staggering amounts of debt that they have to borrow every quarter or every part of the year just to pay the interest on their debt to stay in business. So they're not producing profits or earnings or sound balance sheets. They're just taking on more debt to stay alive. But that's why they're called zombies or Frankenstein enterprises. Right now,
zombie basically means it's never going to be repaid. I mean, yeah, it's dead. It's dead. Dead money that's never going to come back.
Dead money, it's never going to come back. Yeah. Just a rollover, seeing extend and pretend, and arms outstretched, marching along. The other thing that's just an important data point to keep in mind is right now in the US, the ratio of corporate debt, just corporate debt to GDP, is now at all-time highs. That's 57%. You really can't underestimate or exaggerate enough how appalling that is. 57% of corporate debt to GDP. So, in addition to this kind of low quality, very risky debt, you also have a massive disadvantage, because a lot of these zombie companies or otherwise low grade, high yield, junk bond status companies or enterprises nevertheless have an unfair access to cash and capital, and they can continue to issue junk bonds or risky bonds to stay afloat. Many of the small businesses in the US that are on the public exchanges don't have that benefit, don't have that access to capital, can't extend and pretend forever. And that's why, according to a recent Forbes poll, about 40 to 50% of small businesses are poised to shut their doors. So again, we all know what this means, and those who watch the credit markets, how long can this comedy continue? It can continue as long as fiscal and monetary support wants to continue to give more debt or print more liquidity to keep these bond markets alive. When the CARES package and the fiscal stimulus and the monetary stimulus runs out, we are expecting in the credit markets a large wave of foreclosures and defaults on these credit markets. When the credit markets tank, interest rates go up, stock markets tank. Of course, the central bank will step in the US and around the world to try and support those zombies again, print more money, printing more money leads to inflation. It leads to currency debasement. Again, all rivers lead to gold, Egon. So physical gold is the real money that will hedge you against that debasement of currency. What I wanted to ask you about, though, is there's obviously a lot going on. You've written about this recently of what really is real money or an alternative money to fiat currencies. We've talked about how physical gold is the clear answer to that. There's been a lot of talk about crypto in general and Bitcoin in particular. I'd like to get your thoughts real quick before we conclude just on what you consider real money in terms of physical gold versus, say, Bitcoin.
Well, Matt, this is a totally unprecedented situation in world history. We've never had a situation before when basically every single country in the world is indebted to a level that is totally unpayable, and also to level to all measurements to GDP, for example, which is 3 times GDP, 4 times, 5 times, depending on the country. Some countries are slightly less, like Switzerland, of course, which is a sounder country. But overall, this has never happened before. In the past, when you've had a country that has defaulted, that country hasn't been big enough to actually upset the whole financial system. Now you're talking about Japan with massive debts, China, which, debt's gone from 2 trillion to almost 40 trillion just in this century, the US, etc. So every country is indebted. So now there is no one to save another country if they go under, because the world couldn't afford to write off the level of debts that we have now. And that's why I think, sadly, it will implode. And if that implodes, so will assets, sure. The powers that be will do everything they can to fiddle that debt and make it disappear. But if you make debt disappear, so will all the assets. So that's, of course, the reason why we are into wealth preservation. And there's a big debate going on between, as you said, between gold and Bitcoin, which is the best form of wealth preservation. Well, first of all, Bitcoin might be a fabulous investment. I'm not a Bitcoin specialist at all, but I'm aware that it could be a good investment, and it has been for many already. And we could see Bitcoin, some people say it can go to $1 million. Maybe it could. But it is a binary investment in my view, because it could also go to zero. Because if central banks decide that their currencies are the only digital currencies that they are planning to introduce, if they decide that those are the only currencies that will be valid, then they might ban other digital currencies. And then of course, you couldn't use Bitcoin. So I think it could be a good method of payment. It could be a good asset or investment, but it has, in the way that we define wealth preservation, it's got nothing to do with wealth preservation. First of all, wealth preservation assets shouldn't be dependent on electricity, computers, or the internet, because that's a risk in itself. If you stand on an island somewhere and want to trade, and there's no electricity and no internet, what do you do? But so you want to be independent of all of those things, and that's why the Bitcoin doesn't qualify. The other thing is, of course, Bitcoin is hackable. Now they say that, okay, well, it's so protected, and you can do cold storage and take it out of the system. Sure, but every time you transact, you have to be in the system. So, it can be hacked. We know it's been hacked already, and that will most probably increase. But the third point is that it's also, the code can be broken. And that is in my view, a very big risk, especially now with the Chinese supercomputers that are now, they're just coming out with that is 100 trillion times more powerful than existing computers. So they can break any code with that, of course. And I'm sure the Chinese will, the cyber war that the Chinese will start will be dramatic. So again, you shouldn't be on the system, and therefore you also, they shouldn't be traded in the system. And the same with gold, actually. If you have gold, you shouldn't have gold that is traded electronically, because there's a risk also of being hacked or the code being cracked. So if you hold gold, it's got to be held. A wealth preservation asset's got to be independent of the system, not dependent on any system at all. That means so that you have to have it in physical form outside the normal financial digital system. And it's got to be scarce. So Bitcoin is not independent, it's part of the system. it's got to be not of the financial system, but of the internet and computers and stuff. And it's got to be scarce. Bitcoin is scarce, so is gold. So that's fine. They're both scarce. There's only so much Bitcoin produced every. We know we're almost at the maximum. The same with gold. Only 1.5% produced every year, and 1.5% new gold produced every year. And then of course, money, real money, has to be permanent. Permanent, and you cannot argue today that Bitcoin is permanent after a bit of a 10 years history, and therefore there's no chance to call it permanent today. Wait a few wait 5,000 years, or wait a few hundred years at least, and see, it's a new digital system. And there'll be many more digital systems coming out in the future. So this is not a permanent money. It's a temporary digital currency that might survive or might not survive, depending on what governments decide, and etc. So therefore, there is no permanence today in Bitcoin, but there is in gold, of course. So remember, I'm not arguing for or against Bitcoin as an investment. It might be a very good investment, but my knowledge of what's going to happen is not good enough to say that it definitely will be, because of the risks as I outlined. But nevertheless, gold has the history, and it has the permanence. So that's obviously why we stick to gold. And it's for us. It's so simple, and simple things are the ones that last. And history proves that so far, nothing has pushed gold, to the side and become new money, because every other money that's been tried has died in one form or another.
Yeah, absolutely.
So Matt, that's why we're here, isn't it?
Exactly. I mean, gold may not be as sexy or trendy right now, and again, there's no need to denigrate the investment potentials of Bitcoin. But for those who think that Bitcoin is the new normal and gold is some has-been that's going to be an archaic part of history, is a real naive understanding of history and the wealth preservation role that it plays. It's going to continue to be a part of that history. And, again, without having to castigate Bitcoin, if you're talking about wealth preservation, you need an asset that's permanent, fixed, non-hackable, and non-defiant on being diluted by other types of cryptos. So I completely agree with you. And I think it's just worth bringing to the people's attention every now and then.
Yeah, exactly. It's two different things, gold and Bitcoin. That's what we're saying. Both might have a role. We know definitely that gold has a role because of history. Will Bitcoin have a role? We will see. So, sure. Matt, if we don't, obviously you and I will speak, but if we don't speak to our audience before Christmas, we wish everyone a wonderful Christmas and wonderful holidays.
Absolutely.
And we will definitely be back, maybe after Christmas, but sooner in any case. So
fantastic.
Our best wishes to everyone.
Exactly. Fantastic.
All right. Thanks very much. Bye.